Hi, everyone. Welcome. I'm Cindy Davidson, the Education Trustee for SILA Foundation, and today we are delighted to welcome David Maurstad, FEMA Deputy Associate Administrator for Insurance and Mitigation and Senior Executive of the National Flood Insurance Program. Mr. Maurstad is known for his transformative leadership in communicating disaster risk, closing the insurance gap, and incentivizing mitigation actions against varied natural hazards with the primary goal of reducing disaster suffering for all communities. Mr. Maurstad will be sharing with us an overview of FEMA's new pricing methodology known as Risk Rating 2.0. This program leverages best practices and technology to formulate flood rates that are actuarially sound, equitable, easier to understand, and which better reflect a property's actual flood risk. The goal is to fix longstanding inequities in flood insurance pricing and to be better equipped for the reality of frequent flooding caused by climate change. We have an hour, and although everyone is on mute, sorry about that, it keeps the noise down, we will watch for questions in the Q&A, so feel free to ask questions as we go along. Please let us know if you're having any technical issues, and we will try to help you out. And now I will turn the program over to David Maurstad. Thanks.
Hey, Cindy, thank you for that kind introduction and for inviting me to speak to members of the Securities and Insurance Licensing Association Foundation. It's great to be with you all today, and I hope everyone has been staying safe and healthy. Of course, like so many of our meetings these days, I wish that we were able to meet in person. And while that time seems to be getting closer, until then, I'm thankful for having a virtual space for today's conversation. I appreciate SILA's interest in the National Flood Insurance Program's new pricing methodology, Risk Rating 2.0, Equity in Action. Let me start by sharing FEMA believes insurance is the best manner in which to have the necessary resources to start down the road of recovery after a flood event for all property types. I believe we share common ground in our commitment to educate the public on the importance of insurance. So following today's presentation, I hope that you will consider helping us advance our mission to reduce disaster suffering by closing the insurance gap in this country. Pleased that Andy Neal, the NFIP's Chief Actuary, is joining me today. And at the end of my presentation, we'll both be happy to take your questions. To begin, I'd like to provide some foundational context about this new cutting-edge approach that will provide equitable rates for each property's unique flood risk. While I suspect you are aware, however, it seems to be a surprise for some, rates already increase under the current NFIP rating methodology. Respectively, rates are going to increase for some policyholders under the new pricing methodology, and rates will also decrease for some policyholders. Later, I will speak more about what these changes look like across the nation. But right now, I want to highlight how those who will see increases under the new NFIP plan, how that fundamentally differs from rate increases under the existing methodology. Currently, all NFIP policyholders have been subject to premium increases every year. In fact, from October of 2018 through January of 2021, premium increases have been in the range of 10% annually. These yearly increases are in line with statutory limits that require and would continue to occur year after year indefinitely for all policies if no changes were made. In contrast, under the new methodology, once a policy reaches its full risk rate, the increases stop. In fact, we project that approximately 25% of policies will reach their full risk rate within the first year. After 5 years, approximately 50% of all policies will be at their full risk rate, and approximately 90% of all policies are at their full risk rate at 10 years. It is important to understand that the NFIP's ability to identify individual policyholder risk has been improved with FEMA's increased technological and mapping capabilities. As a result of these advances, we now know that 2/3 of older homes, which are currently paying some of the highest rates in the NFIP, will see immediate premium decreases under the new methodology. With no change, current inequitable rates remain, and policyholders for many of these older homes will continue to pay more than they should. This is just one example of how the new plan sets the NFIP on the right course to create a more equitable, accurate, and individualized rating plan. To really appreciate what Risk Rating 2.0 Equity in Action means and how it's an improvement over current rating methodology, it's useful to consider where we're headed in comparison with where we are. Since the 1970s, rates have been primarily based on rather static measurements, emphasizing a property's elevation within a zone on a flood insurance rate map. This approach does not incorporate as many flooding variables as the new methodology. As such, Risk Rating 2.0 is not just a minor improvement, but a transformational leap forward. FEMA now has the capability and tools to address rating disparities by incorporating more flood risk variables like flood frequency, multiple flood types from river overflow, storm surge, coastal erosion, heavy rainfall, and distance to a water source, along with property characteristics such as elevation and the cost to rebuild, which I'd like to highlight, the cost to rebuild. Since the new plan now takes into consideration the cost to rebuild, FEMA will equitably issue premiums across all policyholders based on the unique flood risk of their property. This has been an industry standard for years, possibly decades, that the NFIP is now finally adopting. With equity in action, the NFIP is building on years of investment in flood hazard information by incorporating private sector data sets, catastrophe models, and evolving actuarial science. This includes using FEMA mapping data and NFIP policy and claims data, along with other federal government data from USGS, NOAA, and the U.S. Army Corps of Engineers. In addition, third-party commercially available structural and replacement cost data, along with CAT flood models, is incorporated. This approach is clearly a significant improvement. It allows us to set actuarially sound rates and communicate flood risk more comprehensively than ever before, enabling us to fulfill our obligation to clearly communicate flood risk. And although I don't need to inform you, risk is exactly what flood insurance pricing should be based on. By providing policyholders a clear and concise picture of their unique flood risk, we are also equipping them with the information necessary to make more informed decisions about taking mitigation actions. At FEMA, we believe mitigation coupled with insurance provides individuals with the essential tools they need to recover after disaster strikes. Before I get into further details, allow me to revisit the motivation behind our landmark efforts. It's the why behind all the hard work and commitment that's gone into making Risk Rating 2.0 Equity in Action a reality. FEMA has the statutory mandate to set actuarially sound rates and clearly communicate risk. Risk Rating 2.0 will address an inequity in the program that has built up over time and is not acceptable, an inequity that must be corrected. That is, policyholders with lower value homes are paying more than they should, and policyholders with higher value homes are paying less than they should. The new pricing plan enables FEMA to set rates that are fair and ensures rate increases and decreases are both equitable. In fact, we've learned that 2/3 of older pre-firm homes that have some of the highest rates in the NFIP today will see an immediate decrease in their cost of insurance. The new rating methodology has exposed these inequities, and we cannot turn a blind eye to our policyholders who have been unjustly subsidizing other policyholders. In addition, because our rating methodology hasn't been updated in more than 40 years, it is not fiscally sustainable in its present form to withstand the frequency and intensity of recent events and the storms we know will strike in the months and years ahead due to climate change. Our current system is just fundamentally not working for the program or our policyholders and must be revamped. It is a well-known fact that FEMA has been urged for many years from many quarters to improve its pricing methodology. While difficult, now is the time. Risk Rating 2.0 Equity in Action is transformational, but it is not changing every aspect of the NFIP. Several key features remain. We are upholding statutory requirements by limiting annual statutory premium increases so that most rates do not climb by more than 18% per year. Also, the use of flood insurance rate maps for mandatory purchase and floodplain management continues. FEMA's flood map data informs the catastrophe models used in the development of the new rates, which is why flood mapping data will still be necessary and essential for communities as it will continue to inform floodplain management building requirements and the mandatory purchase requirement. We also maintain program features to simplify the transition to the new plan by continuing to offer premium discounts for pre-firm subsidized and newly mapped properties. And policyholders will still be able to transfer their discount to a new owner by assigning their flood insurance policy when the property ownership changes. Finally, discounts for policyholders in communities who participate in the community rating system, CRS, those will continue. CRS communities will continue to earn NFIP rate discounts of 5 to 45% for their policyholders based on the CRS classification. However, since Risk Rating 2.0 does not use flood zones to determine risk, the discount will be uniformly applied to all policies, regardless of whether the structure is inside or outside of the special flood hazard area, meaning the number of policies receiving the discount will increase. Over the next few minutes, I will walk you through the national analysis for structures in the NFIP book of business, including single-family homes, non-single-family homes, levied and non-levied, for 5 million policyholders across all 50 states, the District of Columbia, and U.S. territories. After which I'll share how the NFIP is planning to roll out the new pricing plan. First, here's what the analysis of the data tells us. 23% of current policyholders will see immediate decreases in their premiums. On average, these will be $86 per month. It doesn't happen under the current rating structure where rates go up every year for all policyholders, regardless of their level of flood risk. This should not be overlooked because it speaks to one of the tenets of equity in action, which is to reflect a property's unique flood risk accurately and fairly and to price it accordingly. Before I move on to the next two categories of policyholders in the blue buckets, you'll recall that I shared that under the current pricing scheme, all policyholders have been seeing an average annual increase of $8 per month. Under the new pricing methodology, 66% of policyholders will see a $0 to $10 per month increase in their premiums. Overall, the impact on these policyholders is relatively neutral in year one, comparing it to if they were under the risk rating current methodology. Another 7% of our policyholders will see on average a $10 to $20 a month increase, which is somewhat more than what they're paying under the current system. And finally, 4% of NFIP policyholders will see a $20 or more increase in their monthly premiums. These policies cover high-value homes in high-risk areas. Currently, lower-value homes subsidize these properties, and in many cases are paying way more than their fair share. Equity in action eliminates this injustice. For this group of policyholders, due to the statutory limits, it could be 10 to 15 years before they reach their true risk rate. Now I'd like to show at a high level what the change means when we break out single-family homes compared to the current rating system. In year one, at their next renewal, 82% of single-family homeowners will see 1, monthly decreases, or 2, increases of $5 or less with risk rating 2.0 compared to the current system. In year one, at their next renewal, 94% of single-family homeowners will see monthly decreases or increases of $10 or less with risk rating 2.0, essentially on par with current pricing. And recall, right now, under the current rating system, policyholders do not receive premium decreases. Earlier, I explained that we've added a property's replacement cost value, or RCV, as a key factor in creating an equitable pricing methodology. Here's why that's significant. Under the current rating system, 45,000 policyholders will see increases of more than $100 a month. The single-family homeowners in this group have an average RCV of $399,643. Under risk rating 2.0, the number of policyholders drops to 3,200, who will see increases of more than $100. And the single-family homeowners in this group have an average RCV of $1,064,537. The numbers speak for themselves. Even policyholders paying the most today will see quite significant and immediate decreases when they transition to the new pricing plan. Broadly, over 1 million policyholders will see decreases. This includes over 600,000 single-family homes. At the extremes, 3,000 single-family policyholders pay premiums above $12,000 up to $45,000 per year. And it may surprise you, as it did me, to learn that these policies are located across the nation, not just along the Gulf Coast. Today, policyholders paying the highest flood insurance premiums can be found in almost every state, except for Idaho, Utah, West Virginia, along with DC and the U.S. Virgin Islands. Again, under the current rating system, these premiums could continue to increase year after year after year. The new plan has an upper bound that limits costs on the highest end of the spectrum. This means that no single-family home policies transitioning to the new methodology will see a premium of more than $12,125 under equity in action. The path forward is to facilitate implementation to the new pricing plan in a phased approach. Although COVID-19 has not directly affected our work with regards to the development of the NFIP's new methodology, we are conscious of far-reaching impacts and that the pandemic has had on the nation and existing policyholders. So for phase one, any new policies beginning October 1st, 2021 will be subject to the new pricing methodology. Also beginning October 1st, existing policyholders will be able to take advantage of immediate decreases in their premiums. This is the fair thing to do. In phase two, renewals of the remaining existing flood insurance policies will be written to the new plan starting April 1st of 2022. That means this group of existing policyholders will have an additional 6 months to prepare for any rate adjustments. As you can imagine, designing a new rating methodology takes an enormous amount of resources. FEMA's investments span across time, people, and technology. We've invested thousands of hours into creating a cutting-edge rating system that is long overdue and years in the making. To give you a sense of time and energy committed to this effort, initial research began in 2016, with design and analysis beginning shortly after that in 2017. From 2018 and 19, FEMA conducted further analysis and laid the foundation for transitioning to the new rating system. In 2020, actuarial rates were finalized and system development began. To complete and integrate the methodology within existing programs and systems required a comprehensive cross-directorate effort throughout the Federal Insurance and Mitigation Administration, including thousands of hours and over 20 experts. This cross-functional team represented a wide array of disciplines, including FEMA actuaries, mappers, floodplain managers, engineers, building sciences staff, underwriters, and mitigation experts. Recognizing the NFIP doesn't exist in a vacuum, the rating team consulted and engaged with insurance industry experts, scholars, subject matter experts, policyholders, and trade groups, along with our partners at the Government Accountability Office. The methodology alone required full-time support from no less than 8 actuary and data experts, as well as the best contractor support available in the industry. These subject matter experts worked diligently to ensure alignment with federal regulations, systems, guidance, and policies. Once the methodology was completed, we then began the process of managing major business changes and the transition to new processes, new technology, and new ways of doing business. We relied on state-of-the-art technology and the best available data to create a modern-day rating system that builds and expands upon years of scientific developments, actuarial data, and environmental analysis. CAT models are the backbone of this new rating structure. The science and data needed to model the full range of perils and magnitudes of flooding is, as an industry, in the early stages. In 2017, a limited number of models were available that could produce average annualized loss estimates for fluvial, pluvial, and coastal flooding. While these models agreed on the general order of magnitude of flood losses for the nation, they could vary greatly by region and by location. However, each available model outperformed analysis based on the current rating plan in terms of reflecting observed variations in flood risk. As a result, a multi-model approach was adopted to determine flood risk using a suite of models, much the same way that NOAA uses several models to determine potential hurricane tracks and magnitudes. The NFIP licensed 3 sets of commercial catastrophe models: Air Worldwide's inland, coastal, and tsunami models, CAT risk inland and coastal models, including modeling of levied areas, and CoreLogic's inland and coastal models. In addition to the commercial flood models, FEMA developed 2 additional models based on government data and models. These models are the mapping data integration and probabilistic flood risk analysis, both of which have been historically utilized in FEMA regulatory flood mapping. We also incorporated other federal agency data, including NOAA slosh modeling and tidal gauge data, and USGS gauge data and the National Hydro high-res data set. Blending CAT models sourced from both the government and commercial entities will ensure the most accurate flood risk rating that the NFIP has ever produced. It's also important to acknowledge that we work closely alongside our partners at the Corps of Engineers to provide an extensive review of our final methodology, including our understanding and analysis of levees. We encourage anyone with questions to visit our Equity in Action website at FEMA.gov NFIP transformation for additional information. There are many resources to explore, including Equity in Action fact sheet, video defining a property's unique flood risk, national rate analysis, state profiles, zip code level data, county level data, methodology data source, premium calculation worksheet examples, and Appendix D rating factors. In closing, let me say Equity in Action will deliver a more equitable and risk-informed NFIP. This is not a check the box and move on effort. What we've developed is a foundational component in conjunction with other efforts that will transform the NFIP, which hasn't had a change of this magnitude in over 50 years. The new pricing methodology puts the NFIP on a path toward a more fiscally sustainable program that is accountable to taxpayers, more accurately reflects flood risk, and helps disaster survivors recover after flood events. Let's turn our attention to affordability, which is an issue currently and will continue to be a concern with the implementation of new pricing. We trust the affordability framework FEMA delivered to Congress in 2018 will continue to be most valuable as this policy discussion continues. The FY22 President's budget includes a legislative proposal for the NFIP that highlights the need to provide affordability assistance to certain homeowners as FEMA moves forward to put the NFIP on a more sustainable financial footing. This legislative proposal would establish a targeted means-tested assistance program for 1 to 4 family primary residences where the household income is such that the federal flood insurance under the NFIP is a burden by providing financial assistance for policyholders who otherwise cannot afford flood insurance. This targeted assistance program would serve to offer low and moderate income, current and prospective NFIP policyholders a graduated risk premium discount benefit. FEMA would implement the program such that eligible low and moderate income policyholders see both the full risk price and the means tested assistance they receive so they understand their true flood risk. Additionally, a successful program would provide additional flood mitigation assistance grant resources to NFIP participating communities and policyholders who are eligible for the means tested assistance program. Overall, a means tested assistance program developed in this manner is expected to increase the number of policyholders and help make obtaining and maintaining flood insurance more affordable for those who qualify. I look forward to collaborating with the administration's team and with Congress on ways to reduce barriers to purchasing flood insurance and pursuing mitigation options to achieve resiliency. That concludes my formal presentation. Thank you for your time and attention. So Cindy, Andy, and I we're happy to take some questions now.
Fantastic. All right. So thanks, Scott. Thank you so much for being here and for taking time with us on this critical subject. Andy, I was going to make a joke about what's the work product look like at the end of 5 years for 8 full-time actuaries, but honestly, I'm so impressed with the reliance on science, on the concentration on a precise assessment of actual flood risks, and also, taking into account affordability concerns. I think that that's absolutely the right way to go, and FEMA and NFIP are going in absolutely the right direction. So love to see that. I was also going to ask a trick question of, let's see, how many homes are in a flood zone? And it's a trick question because I think the answer is every single home has a flood risk. It's just a varied degree of risk. And one of my favorite anecdotes is if you live anywhere in the state of Louisiana, you're in a floodplain, right? I don't know if that's absolutely true, but it's a fun story to tell. And, you know, we work in insurance, so our fun threshold is very low. Then I was going to address, you know, it looks like I think less than 5% of US homeowners actually have flood insurance. So it looks like there's a huge need to get the word out and to, you know, work with the industry and to get more homes protected against flooding. So I'm sure that's part of your mission, because more than, I did a little research I did before this, and more than 50% of homes are at moderate to extreme risk of flooding. I hope I got that right. So very interesting stuff. We've had so many requests from our membership for more programming on climate change and the issues that impact our industry, which I think the insurance industry is among the, you know, highest impacted and earliest impacted, right, by the effects of climate change. I think this marks the first time we've heard from a federal government official on one of our webinars. Since insurance is primarily regulated at the state level, we typically hear from state regulators. So thank you for helping us create a new tradition. I hope we'll continue. Clearly, our industry needs to focus on the education of our insurance professionals, as well as the insurance buying public, real estate professionals, lenders, and other influencers in the flood insurance market. So seeing no burning questions from our tribe, I think I get to release you early. Thanks to a special dispensation from FEMA, we were able to record this after all. So this webinar has been recorded. It will be posted via a link on the SILA Foundation website, so you can share it with members of your team who might also be interested. All of you will be receiving a post-webinar survey. Please be sure to fill those out and provide your feedback. That helps us improve these programs going forward. SILA Foundation provides these webinars free of charge. Here's the commercial part. As part of our mission and outreach, if you learned something of value today, please consider a personal or corporate donation. We rely on donations and sponsorships to keep our programs going, like these webinars. So I'm going to turn to everybody loose, give you a half hour back, and thank you so much for joining us today. Please enjoy the rest of your day.
Thank you.